In mid-May, U.S. President Donald Trump eased some restrictions on the Chinese technology giant Huawei, and the U.S. and China agreed to call a ceasefire to their trade war and resume talks. During the ceasefire, the Chinese yuan mostly traded between CNY 692 and 687 versus the U.S. dollar, which was a remarkably narrow and stable range given all that was happening in the world: Fed rate cuts, turmoil in the crude oil shipping lane along the Strait of Hormuz, Hong Kong protests, and more Brexit drama, etc. But then, on August 1st, 2019, as the U.S. trade negotiating team was traveling back to Washington from Shanghai, the U.S. president abruptly broke the ceasefire by threatening to impose 10% tariffs on $200 billion more of Chinese imports into the U.S., including consumer goods and holiday toys. With the ceasefire broken, can the currency stability last? Probably not. The case for an appreciating Chinese yuan rested squarely on the question of whether optimism for a trade deal between the U.S. and China would emerge. A trade deal would usher in very positive growth expectations in both the U.S. and China. Now, even though both countries were talking trade again in late July, we had trouble seeing a deal happening, even if one's theoretically possible. U.S. President Trump is focused on maintaining pressure on China ahead of the U.S. presidential election in 2020. He does not need a deal, so much as to be seen as being tough on China. We do note that President Trump would prefer to avoid further deceleration in the U.S. economy, for which the trade war has been the main culprit. So expect the presidential jawboning aimed at the Federal Reserve to lower rates to continue. For Chinese President Xi Jinping, the most important point politically for him is not to be seen as being bullied by the U.S. So no deal is required for the Chinese either, and without a deal it is hard to see the Chinese yuan appreciating. The case for a depreciating Chinese yuan rests on the performance of the Chinese economy. The latest published data for Chinese real GDP growth showed only a small impact, but we know of no analyst who buys that story. Chinese exports have been hit hard, and if the economic growth continues to decelerate, then the case for currency depreciation becomes more and more probable. We note, though, that there is an invisible barrier at Chinese yuan 7 per U.S. dollar, a line that the Chinese government has not wanted to breach for fear of angering the U.S. and leading to even further tariff increases. If the Chinese currency gets close to 7, say 695, 697, then the line may hold, but the pressure will be building. And then when it moves through the 7 line, then it will be much more depreciation. Pressure is rapidly released. And it would signal a Chinese economy performing much worse than the published data suggest. We do not know what'll happen, but we do know that the stability of the Chinese yuan is over. Beware of the calm before the storm.